Welcome back to Investing Talk Podcast.
Today we're looking at HIMS and HERS.
As usual, before we start, subscribe, like, and comment to this video to support the show. And to add a little context for you today, our mission is to figure out exactly what is happening under the hood of this telehealth giant.
Yeah, it's been a really wild ride for them recently.
Wild is honestly an understatement. We are looking at a mountain of recent financial data, earnings reports, analyst notes, and market momentum indicators to make sense of some truly chaotic price action. Because it is not every day you see a multi-billion-dollar company do what this stock just did.
No, it definitely isn't. When we say wild, we mean a massive, explosive 40% single-day stock surge.
Right.
40% in one single trading session. I mean, imagine waking up, checking your portfolio, and seeing that kind of jump.
It is jarring.
It is. That is the kind of volatility that forces you to stop whatever you're doing and pay immediate attention to the mechanics driving it. So what for you today is figuring out if this is a momentary blip, like a short squeeze that will fizzle out, or an actual fundamental change in the company's long-term trajectory.
Exactly. The core question you need to ask yourself right now is whether this massive surge is a genuine turnaround, one driven by a surprise truce and a massive new partnership with the pharma giant Novo Nordisk, or if we're looking at a highly risky speculative play that is ultimately masking some very real underlying margin pressures.
Right. The margin issue is huge.
It is.
Yeah.
That's the puzzle we're putting together for you today.
Mm-hmm.
And to solve it, we can't just look at the shiny new headlines. We really have to open up the hood and look at the actual engine driving this company.
Absolutely. So to start making sense of this, let's dive into the company's financial foundation. Because before we can judge if a 40% pop is justified, you have to understand the underlying revenue trajectory.
Okay, let's get into it.
And right now, the top-line growth for this company is nothing short of explosive. They are not just inching forward, they're basically sprinting.
Let's put some concrete numbers to that sprint, but let's break it down so we aren't just swimming in a spreadsheet. Start with where they just finished up.
Gladly. If we look at the fourth quarter of 2025, their revenue hit $617.8 million.
Wow.
Yeah, that alone is up 28.4% year over year. But the full year 2025 picture is where the scale really becomes apparent. For the entire year, they brought in $2.35 billion.
$2.35 billion. To put that in perspective for you, that's almost a 60% jump from the year before. 58.9% to be exact. To grow a base of that size by nearly 60% in 12 months is, well, it's incredibly difficult in the healthcare space. How are they actually pulling that off?
They're doing it by accumulating an absolute army of highly engaged users. The platform now boasts 2.5 million personalized subscriptions.
That's a massive user base.
Yeah, it is. And that subscription base is up 12.7% from the prior year. But here is the most crucial metric for you to pay attention to, because this is what Wall Street really cares about. They are generating $83 in monthly online revenue per subscriber.
$83 a month. I mean, think about your own monthly subscriptions.
Sure.
Your streaming services are maybe $15 or $20. A premium gym membership might be $50. This company is pulling in $83 from every single user every single month on average.
Exactly. And that average revenue per user actually increased by 10.7% year over year. So they aren't just getting more users through the door.
They're making more off the ones they have.
Right. They're successfully convincing those existing users to spend more money every single month, whether that's on hair loss treatments, dermatology, or weight management.
Okay, I have to jump in here and play devil's advocate.
Yeah.
Because as impressive as $2.35 billion in revenue sounds, and as great as those user metrics are, we have to keep our feet on the ground.
Fair enough.
We have to look forward, not just backward. And looking forward into 2026, that unbridled optimism takes a pretty noticeable hit. If everything is firing on all cylinders, why did their first quarter forward guidance spook the market so badly?
That's a totally fair question. The guidance for Q1 2026 was definitely soft compared to what analysts were pricing in.
Soft is putting it politely. The company is projecting Q1 2026 revenue to come in somewhere between $600 and $625 million. Now, to the average person, $600 million in a quarter sounds fantastic.
Sure.
But Wall Street consensus had them pegged at $653.9 million. That's a roughly $30 million miss right out of the gate. It represents a sequential slowdown. But it's not just the slowing revenue growth that worries me. It's what it is costing them to get that revenue. We're seeing some very real margin contraction here.
You're referring to the drop in gross margins in the fourth quarter.
Yes, I am. In Q4, their gross margins dropped by nearly 5%, down to 71.9%. Now, why are those margins shrinking? Because they didn't just magically acquire those 2.5 million subscribers. They bought them.
Through ad spend.
Exactly. I'm looking at their operating expenses, and they spent $238 million just on marketing. Add to that, another $40.9 million dropped on tech and development expenses. They are blanketing the internet with ads, paying a massive premium to fuel that top-line growth, and it is actively cannibalizing their profitability. At a certain point, a business has to prove it can grow without just buying its customers right.
That is a completely valid critique, and the ratio of their marketing spend to their customer lifetime value is absolutely vital to monitor. It is the classic growth versus profitability tug of war. But let me counter that by looking at the broader financial health, specifically their balance sheet.
Okay, let's hear it.
Because even with that incredibly heavy marketing spend, this is a company with a remarkably debt-light profile. They're sitting on a massive war chest. They ended 2025 with $577.5 million in cash and short-term investments.
Wait, so despite spending nearly $250 million on marketing in a single quarter, their cash pile actually went up?
Immensely. They had $300.3 million at the end of 2024, so they essentially almost doubled their cash buffer to that $577.5 million mark, all while growing revenue by nearly 60%.
That is impressive.
That cash generation is the ultimate proof of concept. It proves that the underlying business model works and generates free cash flow. It means they can fund their international expansion, their heavy marketing, and their research and development without having to go to a bank and take on crippling high-interest debt. And that brings us to the core of their valuation, which is their competitive moat.
Let's explain that for a second. Because in investing, a moat is essentially what protects a company's profits from being eaten by competitors. For a traditional business, a moat might be a patent or a massive factory. For a telehealth company, what is the actual moat?
It's all about switching costs and ecosystem lock-in. Their direct-to-consumer telehealth platform creates incredibly high friction for a user to leave. When a patient gets their personalized prescriptions, their lab results, and their physician consultations all integrated into one seamless app on their phone, they simply do not want to cancel that and go back to sitting in a traditional physical waiting room.
The convenience is the sticky part.
Exactly. The convenience becomes the moat. And here's where it gets really interesting. This existing moat has just been fundamentally supercharged.
You're talking about the Novo Nordisk deal.
Precisely. This new partnership with Novo Nordisk grants them access to sell authentic, branded GLP-1 weight loss drugs, like Wegovy. To understand why this is such a massive deal, we have to use an analogy. For the past year, telehealth companies have been making a fortune selling compounded weight loss drugs.
Right.
Compounded drugs are essentially custom-made copies mixed by pharmacies because the name brand drugs are in a national shortage. It's technically legal, but it is risky. Selling compounded drugs is a bit like selling a very high-quality knockoff handbag out of the trunk of a car. It works, people want it, but you're constantly looking over your shoulder because the original designer might sue you or the authorities might shut you down.
And Novo Nordisk is the original designer in this scenario. They're the pharma giant that actually invented and manufactures these wildly popular GLP-1 drugs.
Exactly. So by signing a direct partnership with Novo Nordisk, HIMS and HERS just got the official franchise license. They aren't just selling generic compounds in the gray area anymore. They are partnering directly with the manufacturer of the most sought-after weight loss drugs on the entire planet.
Which changes everything.
It completely reshapes their offering, legitimizes their weight loss vertical, and builds an incredibly wide moat that smaller, pure-play, compounded telehealth competitors simply cannot cross.
Okay, if the underlying business is generating cash, and they just secured the golden ticket of pharma partnerships, how do we explain the absolute bloodbath this stock went through before this week? Because the financial fundamentals only tell half the story. The price action leading up to this Novo Nordisk announcement was a nightmare. Let's pivot to the charts.
Yeah, looking at the technicals reveals a lot.
It does. If you were holding this stock through the early months of 2026, it was a genuinely brutal ride.
It was a very dark period for the valuation. The market was completely ignoring the revenue growth and fixating entirely on the risks.
Dark is putting it mildly. Let me paint the picture for you. By March 6th, 2026, the shares had literally cratered. They hit a bottom of $15.88. Just to give you the full context of how painful that was, that represented a 37.8% drop in just 30 days. And if you zoom out to the year-to-date performance leading up to that exact day, it was a massive 52.5% decline. Think about that. If you put $10,000 into this company on January 1st, by the first week of March, you were looking at less than $5,000. More than half the company's value was simply vaporized in a matter of months.
And the narrative during that slide was relentlessly negative. The market was entirely focused on the legal threats from pharma companies over those compounded drugs we just talked about, combined with the fears over that margin compression.
But then came March 7th.
A dramatic, violent reversal. The Novo Nordisk deal announcement hit the wire, and it triggered that 40% stock surge in a single trading session. This wasn't just a slight bump on good news, it was an absolute explosion.
Break down the mechanics of that for a second. What does an explosion like that actually look like in the market? Because stocks don't just jump 40% smoothly.
No, they don't. It means the momentum completely flipped, driven by explosive algorithmic trading volume. When a stock gets beaten down by 50% over a few months, there are a lot of short sellers. Investors betting that the stock will keep going down.
Right.
When massive, unexpected good news hits, those short sellers panic. They have to buy the stock back immediately to cover their losing positions. You combine that short covering with institutional investors rushing in to buy the dip and retail investors chasing the headline, and you get a volume surge that breaks the system.
A perfect storm.
Exactly. The narrative in the market instantly flipped from, oh, this is a risky company about to be sued out of existence,
Right,
to undeniable aggressive upside momentum. From a technical chart perspective, a surge with that kind of volume likely cleared out several major psychological resistance levels. The dark cloud hanging over the stock was the legal feud over GLP-1 drugs. Now that the truce is in place, the technical ceiling has been blown wide open.
Which brings us perfectly to how the market is digesting this moving forward.
Moving on to market perception.
Because the way Wall Street and the media feel about a company can often drive the price action just as much as the actual balance sheet.
Oh, without a doubt. And right now, the quantitative scoring and the news flow are definitively overwhelmingly bullish. The mood has totally changed. It is night and day.
What are the numbers showing?
If you look at the top 5 most recent specific news stories covering the company since the announcement, the breakdown is very telling. 4 out of those 5 stories are strongly bullish, and the remaining one is neutral. There is not a single aggressively bearish headline in the top tier of financial media right now.
It's amazing how quickly the story changes when the legal threats disappear. Just a few weeks ago, headlines were dominated by a bitter legal feud over compounded weight loss drugs.
Yeah.
Now, the media is calling it a surprise rescue and celebrating the brilliance of the partnership.
It's a complete 180.
It really is.
Yeah.
But here's where it gets a bit complex and where you really need to pay attention to the nuances of what analysts are actually doing versus what they are saying. Let's look at a fascinating, almost contradictory signal that came from Barclays on March 5th, 2026, literally 2 days before the big news broke.
Ah, yes, the dramatic price target cut.
Exactly. Barclays slashed their price target for the stock almost in half. They took it all the way down from $48 to $25. But crucially, and this is the important part for you to understand, despite cutting the target by nearly 50%, they maintained an overweight rating on the stock.
So let's unpack that. How does an analyst cut a price target so drastically, essentially saying the stock is worth half of what they previously thought, but still tell their clients to overweight the stock in their portfolios?
Well, isn't that just a Wall Street analyst trying to save face? I mean, this stock had just plummeted by 52%. If they kept a $48 price target when the stock was trading at $15, they would look completely disconnected from reality.
That is certainly part of it. They were adjusting to the harsh reality of that brutal price action of early 2026. They were forced to reset their valuation models, but by keeping the overweight rating, they were sending a very specific signal.
Which is?
In analyst speak, overweight means they still believe this specific stock will outperform the broader market or its sector peers over the next 12 months. They were saying, look, the highs of the past were too bubbly and the multiple has compressed. But at this new floor of around $15 to $20, the underlying business is too strong to ignore. It is still going to beat the S&P.
That makes sense.
Yeah, they saw the intrinsic value. They just had to adjust the math to reflect the market's current fear.
And when you look ahead at the broader macro environment and the speculative catalysts on the calendar, you can see exactly why they might remain optimistic about that outperformance.
What specific catalyst should we be watching for on the horizon?
There are two major things. First, on a company-specific level, Q1 earnings are expected in late April or early May 2026. That is going to be the absolute moment of truth. Wall Street is going to be watching like a hawk to see if that soft $60 million guidance miss was just management being overly conservative or if growth is actually slowing.
Right, that will be critical.
Second, and maybe more importantly, there is a broader macro rotation happening in the market right now. Capital is moving heavily out of speculative tech and into the healthcare sector.
Driven by the inflation data, right?
Exactly. We are seeing stable oil prices and stable CPI data. CPI, or the Consumer Price Index, is basically our main gauge for inflation. When inflation calms down and stabilizes, the macro environment feels safer. When that happens, institutional money tends to rotate into high-growth sectors that have massive, undeniable demographic tailwinds. Personalized healthcare and weight loss management are at the absolute top of that list.
They're perfectly positioned for that rotation.
Okay, the 40% pop is exciting, the macro environment is favorable, and the cash pile is huge. But time to look at the bear case.
We always have to look at the risks.
We do.
Yeah.
No matter how bullish the headlines are today, we have to understand what could go horribly wrong. And the first major hurdle is going back to that guidance miss we discussed earlier.
The Q1 projection versus expectations.
Yes, I'm going to double down on this because it really matters for the long-term viability of the company. They guided for $600 to $625 million in Q1 2026, while the market expected $653.9 million. If that sequential slowdown is real, you have to question the sustainability of the business model. If they continually have to spend $238 million a quarter on marketing just to keep the subscriber count growing, customer acquisition costs are going to eventually outpace the lifetime value of those users. If marketing spend keeps rising, it is going to keep eating into that 71.9% gross margin. And Wall Street will only tolerate margin compression for so long before investors demand actual, robust, bottom-line net income, not just top-line revenue growth.
It's the ultimate test for any direct-to-consumer brand. Can you pivot from aggressive acquisition to sustainable profitability?
Precisely. But there is another, potentially much darker layer here, the legal and regulatory residuals.
You mean beyond Novo Nordisk?
Yes, because even though the specific feud with Novo Nordisk is settled because they partnered up, remember that 52.5% drop earlier in the year. That drop proves definitively just how incredibly vulnerable this company is to intellectual property risks and government intervention. Their previous reliance on compounded GLP-1 weight loss drugs exposed them to massive existential threats. And you need to be warned, there is ongoing broader regulatory scrutiny in the booming weight loss sector.
The FDA is deeply involved here.
They are watching this space like a hawk. Compounded drugs are a massive gray area. Any misstep, any new adverse health event, or any new sweeping regulation regarding how telehealth companies are allowed to prescribe these medications online without an in-person visit could trigger another violent downward spiral in the stock. The stroke of a regulator's pen could wipe out their fastest-growing segment overnight.
Those are significant, potentially existential risks, and they absolutely shouldn't be ignored. But to provide a rebuttal, you have to look at the specific tools the company has built to manage and absorb these threats. The risks are largely manageable right now precisely because of that massive $577.5 million cash buffer.
The big cushion.
It is. If customer acquisition costs rise due to ad fatigue, they have the cash to weather the storm and pivot their marketing strategy without diluting shareholders by issuing new stock. If regulatory hurdles require massive new investments in compliance and legal teams, they have the war chest to handle it.
It's a remarkably strong safety net. Most growth companies in telehealth burn cash. They don't hoard $500 million of it.
It is a phenomenal safety net. And more importantly, the new branded drug partnership structurally de-risks the major legal threats you just mentioned. By partnering directly with Novo Nordisk to sell authentic Wegovy alongside their other offerings, they are actively moving away from the regulatory gray area of compounded drugs.
Which is huge for institutional confidence.
Exactly. They are aligning themselves with the gold standard manufacturer. They essentially took their biggest vulnerability, the legal threat from pharma giants, and turned it into their strongest, most defensible asset.
That is a fascinating way to look at it.
Let's bring it all together for the final verdict. We've looked at the explosive revenue growth, the massive cash pile, the brutal price action, the short squeeze mechanics, the shifting sentiment, and the very real regulatory risks. After synthesizing all of this data, what is the final takeaway for the listener?
Well, what's the score?
We have an official quantitative score based on all of these metrics. The official bullish score for the company right now is an 8 out of 10.
8 out of 10. Despite the guidance miss and the regulatory fears, that is a highly confident score.
It is. And the final multi-year investment thesis boils down to this. HIMS and HERS has established itself as a definitive, undeniable telehealth leader. They proved that with 59% year-over-year revenue growth and by building a highly loyal recurring revenue base of 2.5 million subscribers. But what takes this from just a good company to an 8 out of 10 investment thesis is the supercharger effect of this week's news. By resolving their legal risks and unlocking branded GLP-1 sales, they have legitimized their most lucrative vertical.
It is the ultimate catalyst.
Yes. Despite the short-term softness in their Q1 guidance, their massive cash pile gives them the financial runway to execute aggressive international expansion and eventually drive margin recovery as their users mature. The target horizon for you to consider here is not a quick, speculative day trade hoping for another 40% pop. This is a multi-year hold. You are positioning yourself to ride the massive, unfolding wave of GLP-1 adoption globally, backed by a tech-forward platform that knows exactly how to acquire and retain users at scale better than almost anyone else in the space.
It is an incredibly compelling setup, perfectly balancing a proven cash-generating subscription model with the explosive upside of the current global weight loss revolution. As usual, before we finish, subscribe, like, and comment to this video to support the show. But before you log off today, we want to leave you with one final thought to mull over on your own as you research this space. We've talked extensively today about the Novo Nordisk partnership as a defensive, brilliant move to end a legal feud. But zoom out and ask yourself this: what happens to the traditional brick-and-mortar primary care doctor if tech-driven telehealth platforms start securing exclusive distribution deals for the world's most popular maintenance drugs? If you can get your labs, your consultation, and authentic Wegovy shipped directly to your door without ever leaving your couch, why would you ever go back to a waiting room? Are you ready to ride the volatility of personalized health tech as it attempts to completely replace the traditional healthcare model? Think about it. Until next time.